Welcome back to the Wealth Builder podcast. I'm your host, Nick Donato, financial advisor at Guidance Financial. We've now settled into the new financial year, a couple of months in, but there still seems to be lots going on at home here in Australia and overseas. We've still got wars going on, we've still got inflation issues, there's housing price issues, lots is happening. Over the last couple of weeks, we've found two stories quite interesting. One about international markets that might have been missed a little bit, and obviously the house price issue or house price downturn. So me and Paul from Guidance as well are going to take you through those two issues and have a bit of a discussion around them. Let's crack in. Thanks for joining me today, Paul, to have a chat around what's going on here and around the world.
Hey, no worries, Nick. I'm looking forward to jumping into these two topics because, both super interesting and, lots going on, as you mentioned in the intro.
So you raised with me a couple of days ago that the international stock exchanges are increasing their trading hours. Do you want to take us through a bit of
Yeah,
what's going on?
this is one, that I was keen to really dig into because I think this is super consequential, and yet I haven't seen it get any mention at all in the Australian press. And to be honest, I come across it in the Wall Street Journal, and even there, it wasn't a headline; it was a little bit buried. But I think for Australians, it's really consequential. So, the news is the Nasdaq, which is the second biggest exchange in the US, particularly tech focused, they will be moving to 23-hour trading. And their target date for that to happen is the 6th of December, and that will be 5 days per week. So they kick off trading Sunday night and then they go through until Monday night. The 1 hour that they're closed is between 8 p.m. and 9 p.m. So it means on a Sunday night they kick off at 9 p.m. US time, which translates for Melbourne, Sydney, that's 1 p.m. our time. So they will open now in our afternoon. So that's the Nasdaq. They've given a firm date. The New York Stock Exchange also has regulatory approval. So that was the sort of key thing is the regulators have approved it. That was the thing that was the hold-up. So the New York Stock Exchange is also approved. They haven't given a date yet, but they've indicated that they expect to go to extended trading in December. And then the third exchange in the US, which is the CBOE, which it also owns one of the exchanges here in Australia too. I think it's the X one. But they've indicated December for them as well. So presumably all three exchanges in the US are going to go to 23. I mean, this potentially 24, but anyway, 23-hour trading is probably enough, or by the end of the year. Now, the reason that I think that is so consequential is because those markets will now be open during Australian business hours, and not just Australian, but of course all across Asia. And in terms of why the US markets would want to be open at night, I mean, there's multiple benefits, but a key reason would surely be so that people on our side of the globe can trade in the stocks on those markets. Now, we've already got a situation where the US market makes up about 70% of all global shares. But I think this move potentially really enhances their dominance. Because like if you're a share trader or even just a regular investor, like for at the moment, right? Let's say you wanted to buy an ETF of the S&P 500, right? Now, at the moment, you do that on the ASX and you've got a couple to choose from. But you could buy an ETF of the S&P 500 on the US markets and the management fee's cheaper because they got much higher volumes, much higher liquidity, right? So why would you buy an ETF on the Aussie market when you could almost as easily buy it in the US market at a lower management fee?
There is that management fee. There is, lower fees potentially, but does exchange rate, Aussie dollar, US dollar,
Right. Yes,
Asian yen, US dollar make a difference,
it
do you
does.
think?
Yeah, yeah, yeah. But I mean, it will, and that will be an interesting facet, right? Um, I mean, I suspect you would have your US account and you would just leave everything in US dollars and you would enter and exit your positions. You'd move your Australian dollars into your US account, which like ComSec facilitates that right now. And then you'd probably just leave it in US dollars and then only switch it back to Aussie if for some reason you needed to get the money out. You know, you've retired or whatever, you wanted to buy a house or something. But all through during your duration of investment, you just keep everything in US dollars. But still, you're dead right. That could be really consequential, right? If you shift your money over when the exchange rate's at 70 cents in the dollar, and then 5 years later you want to pull it back out and the exchange rate's moved and it's now 85 cents in the dollar, then that could remove the any gains you've had in the shares, but it equally it could enhance the gains you've had, right? Depending on which way the exchange rate moves. So, absolutely, that's an interesting facet, and it'll be interesting to see whether the brokers introduce any kind of hedging capability where you could take out insurance on that, or yeah, just what evolves from that. But you're dead right, exchange rate's a consideration. Yeah. Um, I mean, just other sort of knock-ons. So in the US, they have market makers. We do to an extent here too, particularly for ETFs, right? Which are institutions that just ensure that there's always liquidity in the market. So there's always a buyer and always a seller. So if someone wants to trade, there'll be someone on the other side. Now, with moving to 23-hour trading, those US institutions are going to have to they're going to have humans available to do that market making. Obviously, computers take a big load, but you're always going to want to have some human oversight. So there's an expectation that since they now have to effectively man the desk for, might as well be 24 hours in the day, well, they're probably not going to do that in the US, right? So there might be some good job opportunities here in Australia, but who knows? It could be in Singapore but somewhere in this hemisphere, where your US institutions are now going to need an office on the other side of the world so that their trading desk can operate during the day in the US, and then when it becomes night in the US, they need to still operate. So then they would flip to their department on the other side of the world to trade, which is exciting from a job opportunity perspective in financial services.
Again, being devil's advocate here and not knocking down your points, but being devil's advocate here, isn't the world getting smaller? Isn't AI doing half the jobs, supposedly, or coming in to do half the jobs? So won't AI and all the tech that everyone's working on just come in and revolutionize everything as everyone thinks it will and take
Well,
those jobs?
when it comes to markets, we've had computer trading for years, right? Hedge funds have been doing that for an extraordinary long period of time. I mean, when I say extraordinary long, a decade or more, right? That's where your Citadels in particular, but there's lots of them. They've been doing that for a long time, right? So automated trading, computerized trading, it didn't take AI to do that. I mean, and in fact, there's some suggestion that that space is actually where AI kind of really got started, right? Because if there's money to be made, if someone can figure out how to trade more quickly, then of course they're going to try and
Mhm.
grab that opportunity. So really, that's already in the market, right? So that's not going to change. Uh, but again, you still need human oversight to make sure that the computers aren't just going completely awry. And they're always, for instance, Citadel, and I don't know a ton about them, but I know in terms of their recruitment, they're always looking to hire your mathematics PhDs, right? Because yes, they've got the computers to do the trading, but they've got to train the computers, if you like, on, they've got to develop the algorithms on what to trade and set in the parameters and when there's an opportunity and these sort of things. And so you still need humans to do that sort of work as well, right? Um, yeah. So look, as I say, to me, this move to extended trading is really consequential for Australia, and by extension, I think the ASX as a standalone entity, I think its days are numbered. I mean, I would be surprised if the ASX as a standalone entity is still here in 3 years' time. Now, I mean, I can't think of the exact year now, but I think it was early 2000s. The Singapore Stock Exchange proposed a sort of a merger in inverted commas, but really that was just to be polite. It was really a takeover. the Singapore Stock Exchange and the Australian Stock Exchange coming together. And Peter Costello at the time, he was the treasurer at the time, he knocked it back on national interest grounds. But really, the Australian market as a standalone entity, I just can't see that that has a future. I mean, most of the European markets have merged now, and I think ultimately some of them are owned by the NASDAQ parent company and some are owned by the New York Stock Exchange parent company. A lot of the markets around the world have merged. Our Aussie market is a standalone when, as for you and I investors,
Mm.
during the day, we could just jump into our ComSec account, get into the international area of that, and then just as easily buy whether we wanted to buy ETFs or whether we wanted to buy Nvidia or Apple or Microsoft. Why are we going to be on the Aussie market and be restricted to, Commonwealth Bank and BHP, which incidentally, Commonwealth Bank and BHP, you can buy on the New York Stock Exchange too, because there's depository receipts for the big companies anyhow. So even if you wanted a bit of Australian flavour, you could do that on the US market anyhow. I dare say there would be ETFs. I haven't looked, but I'd be shocked if there wasn't an ETF on the US market that covered Australia. So you could even do an Aussie share ETF. Now, I mean, franking credits and stuff are obviously a consideration for Australian shares and Australian shareholders. So maybe that's where it keeps it alive. But the ASX I would have thought, it's going to end up merging in with something like the NASDAQ or the New York Stock Exchange. And so, the companies will still be tradable, but does it need to be its own standalone entity, especially when the ASX has really struggled? They've been trying to replace the CHESS system for an eternity. They were trying to do it with some sort of blockchain type solution, and it just all fell over. And I think that they're having a second crack, but that's a ton of money to try and resolve that issue. Just merge in with someone who's already figured that out, right? And made that investment. Why would the ASX spend hundreds of millions of dollars trying to develop a new clearinghouse system if there's an exchange that's already done it, right?
Yeah, from a diversification point of view, though, to have, we have clients with money in the S&P 500 and the ASX 200 and different sectors and exchanges around the world. So I can see an argument being made from an investor point of view to have some additional diversification, even though, as you said, you could probably buy a Aussie ETF on the US market or on the NASDAQ or a Asian ETF there or a European ETF, but just from a level of diversification, it might
Yeah,
make sense
but
to.
why does the exchange matter? I
Yeah.
mean, I hear you on diversification, but does it matter what exchange you use? Like, because at the moment, right, like there's the ASX, but what's the second exchange? Is it Chi-X? I think it changed its name, right? But the reality is, when we buy shares or ETFs, we don't even know. Like, if we get into our, whatever our brokerage account is, we don't actually even know what exchange the broker uses to do that transaction. Like, who cares, right?
Hmm.
So, for you and I, absolutely diversification is relevant. I think really the only element there is around exchange rate, right? But in terms of, yeah, if you want emerging markets or if whatever, you could probably do that more easily on the New York Stock Exchange or on the Nasdaq, right? There's going to be more options. Um, so yeah, look, as I say, just to me, I think this news, which I haven't seen mentioned anywhere in Australia, but I think it's massively consequential to Australia. Even what the recent SpaceX float, right? ComSec offered retail investors the opportunity to participate in that float, which is the first time Australian retail investors have been able to participate in a US stock market float. And apparently there's a lot of interest. Okay. So that tells you, I mean, look, there's the whole Musk factor and everything else. Like that was a bit of it was a big event as much as, and the share price went up and it's come back down again now. We'll see how that plays out. But nevertheless, ComSec was willing, I mean, they're the biggest retail broker in the country. They were willing to facilitate their customers investing direct in the US, right? And there was customer demand to do so. So again, just further illustrating, a lot of these things are in place. And if the US market it opens for 23 hours a day, my expectation is a lot of investors are just going to say, well, if that's the case, that it's kind of the last barrier to me investing over there. I mean, a lot of people are investing in the US already, of course, but the fact that it's not open during our business hours does make it a bit tricky because you can't easily place a trade and know that it goes through. And, it's a bit tricky to sort of place the trade when the market's closed. It's not prohibitive, but it's not as good as if the market were open. If that barrier is removed, again, just to me, why would you continue to invest on the ASX? I just think it's really consequential, and then it has all sorts of knock-on effects. Like, for Australian companies that want to raise capital, well, do they do it on the ASX, or do they need to go to the US? Like Atlassian, for instance, our biggest software company, right? They're just listed in the US. They're not even listed in Australia. They have different listing rules. I mean, one of the most obvious is that they need to give quarterly profit updates, whereas here in Australia, we only have to do half yearly profit updates. So there's different requirements there. There's also, it'd be interesting, in Australia, our regulator is very much sort of protect the individual, right? It's sort of, okay, well, I think of it at least as, who's the dumbest possible person? And all right, let's write the law to protect them. It's very protective, right? The US is not really like that. They're much more pro-business. So things like leveraged ETFs that we don't have, the US does, right? They're much more aggressive and more, you know what, if someone's stupid enough to blow up their money, well, that's their problem, right? So if Australian investors are more and more using the US markets to invest, then I can't see how our regulator can prevent Australian investors going in those more aggressive type investments, which will then sort of change. Yeah, it changes sort of how we operate, right? That ASIC has a lot less control if the market that people are investing in is the US market and therefore controlled by US regulators. So there's so many implications, I think, for this, and this is why I wanted to flag it in the podcast, Nick, because as I say, I just think it's going to be huge. And 6th of December it kicks off. I mean, assuming there's no technical issues that prevent them doing that. Well, that's what, 3 or 4 months away. I mean, it's almost upon us, and it's getting absolutely no discussion.
Yep, yeah, very interesting to see what happens in markets in the US in the Nasdaq. I'm guessing nothing immediate would really kick off. It might take a little bit for people to jump on it and understand what's actually going on, and then yeah, when it kicks off and it gets taken by investors and by the public, it'll be an interesting couple of months to see. Yeah, volatility would probably be high here and over there, so interesting times to see what happens around that.
Yeah, well, I mean, and that is a consideration, right? Is liquidity, will liquidity in the US markets be thin overnight, which therefore potentially enables market manipulation? But that's another reason why these markets, when they open up, I've got to assume they're going to promote heavily across the Asian markets to
Hmm.
to counter that, right? They want liquidity to keep markets efficient and to ensure that people aren't gaming the system, right? So, yeah, I mean, in the US, there are accounts where you pay zero brokerage. It's not at all uncommon, right? Now, brokerage in Australia is pretty cheap anyway. It's usually 20 or $30, but it's not zero, right? So, yeah, and like I say, ETFs are cheaper over there. You've just got a much broader set of investments. And yeah, and you can still get access to the biggest Australian companies, just not the smaller ones. So, but again, potentially that's just a case of a merger, and so that the Australian, because it's not like the Australian listed companies are going to vanish, right? But are investors still going to spend a lot of time in that space when they could just as easily go straight to the US?
Hmm.
Anyway, look, I've probably banged on enough about that, Nick, because I know you
That's
wanted to talk about house prices. So did you want to
yeah,
take that one?
yeah. So obviously here in our own backyard, we've had those few budget changes and interest rate hold was the last call. So lots of things happen, and there's been a lots of volatility in the past few months in the housing market. Obviously, the budget was meant to make housing more affordable for young Australians and those trying to get into a home, with the removal of negative gearing for new new purchases, but new existing
Yeah,
purchases.
exactly. New homes, you still get negative gearing. Yeah.
New builds, you still get negative gearing. You know, Chalmers has said that we shouldn't judge housing volatility over a few months, which does have some merit because we like to focus on the long term and
Mm.
watch markets recover in the long term and see how they perform, and don't like to focus too much on short term volatility because lots can happen in the short term. But over the last 3 months, nationally, house prices are down 0.7%, which doesn't sound huge. But when we look at the Sydney market, that's down 3.2%. The Melbourne market, that's down 2.6%. So it is just 3 months, but there's some pretty reasonable decreases in house prices. And whether that's a good thing or a bad thing, it depends who you are, I guess. What do you reckon, Paul?
Mm. Yeah, I must admit, I'm in the camp of it's probably a good thing.
Hmm.
I mean, forever people have been talking about how are young people supposed to afford to buy a house, and if that's going to improve, then that necessitates house prices going down. Now, no one wants to see them fall off a cliff, of course, because that's going to be terribly destabilizing, and especially so if you bought a house a year or two ago and then you end up underwater. So the fact that it seems like prices are deflating, but not, as I say, not dropping off a cliff, I think is pretty good. Yeah, I was looking, yeah, year on year now, like Melbourne and Sydney are negative, but it's really the last quarter that's driven that. In fact, the
Yeah.
Sydney prices, yeah, it was positive up until that quarter, and then there's been a negative 3.5 or whatever it was for the quarter, has then pushed the yearly figure into negative. So it seems like Sydney's the one that's building a bit of momentum, but then that's the one that's highest price, so that probably has the greatest scope. The other thing,
Mm.
I've had a few discussions with clients on this recently. Quite a few of my clients are in Sydney, and like I get, your house was worth whatever. It was worth $3 million last year, and now it's worth 2.7 or something. I mean, you don't know until you sell it, right? So it's all a bit rubbery with property prices, but let's go with something like that. And that's probably extreme. Look, that's a 10% move. It probably hasn't moved that much. But nevertheless, um, okay, so it was temporarily, maybe it was worth $3 million a year ago. I mean, you don't know because you didn't sell it. But the year before that, maybe it was worth 2.7, and the year before that, it was probably worth 2.5. And so, and 10 years ago, maybe it was worth $2 million. So the fact that it's worth 2.7 now it's still increased a lot, right? Now,
Hmm.
of course, the market looks like it's still falling, so maybe there's further adjustment. But the only ones that are really screwed over are the people that bought a year or two ago because they've paid the sort of inflated prices, if you like, and they've got the mortgage to show for it, and and the prices are coming down. So it totally sucks if you're in that position. But for everybody else, you can't anchor to this previously higher price and then say, well, forever more, because this is what I've heard. I've heard people say, oh, well, last year it was worth, in that example, $3 million in Sydney. Well, it's not that worth that now. So therefore, I'm not going to sell and I'll wait till it gets back to $3 million. But why anchor at that particular point, which is rubbery anyway? Because like I say, you didn't sell, so
Yeah,
you
who
don't really know if
knows?
it was worth 3 mil. But you're choosing a particular high point as your anchor. Just seems unreasonable to me. I mean,
Yeah.
what did you make of it?
Yeah, I agree. And I think, if you did buy 1, 2 years ago and now your house is worth $1 million, oh, well, you bought for $1 million and now it's worth 950, 970, but you've got a high mortgage. Like, at the end of the day, depending upon the purpose of the property, if it's your house to live in and, it's your forever home, so to speak, it doesn't really matter that the house price has gone down
Mm,
because you have no intention to sell it.
yeah,
You're going to be there for the next 10, 20 years, however long it is. So it all comes down to, your intention. So again, if it's your house to live in forever, I'd say forever, but forever, so to speak,
long term anyway.
long term, I don't think it really matters. It's not too much. I wouldn't be concerned at all because, house prices 10 years ago were lower. House prices 20 years ago were lower than where they are
Yep,
today.
yep.
Um, If it was for an investment purpose, that's probably where you're the most unhappy. But we've always, spoken about supply issues. They're building more houses. What's happening? So if this trend was to continue with house prices to continue to decline, it'd probably, as you said, it'd probably be a decent thing to help younger Australians get in. If that means that the other side to look at it with inflation, rents are potentially rising. Investors might be holding on to the property, waiting for a recovery or for it to go back up. So there
Or
might
they
be
might be
a
holding onto the property because it's been grandfathered and still has negative gearing. And if they trade, they lose that. So that's another reason for the investors to hang in there.
correct. So supply, there's the illusion that supply should increase because, again, things are getting cheaper, houses are coming down. But will it if people don't want to offload these properties because of the decrease in price?
Hmm.
So it's a bit of a double-edged sword to see what actually occurs over the next 6 to 12 months if prices continue to go down, if, houses, I don't know the stats, but you hear a lot recently that houses are going to auction and then just being passed in and not sold if that continues. So there's a lot to play out still
But
in the housing market.
that's what I'm talking about in terms of the anchoring, right? The seller has an expectation for this price, and okay, gee, I can't get that price anymore, so therefore I'm not going to sell. But that anchoring, that reference point, it was just one moment in time that was just potentially a bit of an artificial peak. With the benefit of hindsight, of course, we didn't know that at the time. Um, Really, the market will tell you what it's worth, right? This is what people are prepared to bid. And oftentimes, when someone's selling, they're also buying, right? They might be
Hmm.
downsizing, or maybe it's a family looking for a bigger home. So they're in and out of the same market. So if they sell something, yep, it's worth a bit less than it was a year ago. But what they're replacing it with is also worth a bit less than it was a year ago. To your point, it's really investors, I think, that are probably the ones that feel it the most. And they're a bit of recalibration there, I think, would be a good thing because, we've talked about in the past that the sort of property investment is a bit of a religion in Australia. Like, if you pull out a spreadsheet and do the numbers, it often doesn't really stack up, but it's kind of irrelevant because people just have this perception that I don't need to do the numbers. I just know that property investment's good. Property always goes up, negative gearing, blah, 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 blah. Irrespective, whatever. I'm going to go property because that's what everyone does. That's what my friend did, and blah. And yeah, and you can often do the analysis because what's always ignored with property is the fact that they wear out, and so eventually you need new carpets. It needs a paint job every now and again. Sooner or later, it needs a new bathroom, a new kitchen. One day, it'll even need a new roof. And that's a lot of money that just gets completely ignored in a lot of the stats and calculations. And so often I've seen when people go back and add up, okay, well, I had this loan and here's all the cost associated with that. And then here's all the maintenance and bits and pieces along the journey. Very often it's not a very good investment to begin with, right? So to the extent that maybe this just is a bit of a recalibration, of course, people are still going to invest in property and it's a valid, uh, uh, diversifier and, go for it, right? It's good. Yeah, fine. Gear up, leverage, all the rest. But just slightly taking the heat off that as what some people perceive as kind of the only game in town is, I think, a good thing because actually, to, I mean, I'm biased towards shares, as most listeners would know, but just philosophically, if you're investing in a company, whatever, the Commonwealth Bank, Microsoft, whoever, well, that company's generating profits. Some of that profits it pays out as dividends, but the remainder of the profits it puts back into the business to grow the business, right? So therefore, it makes sense that over time that company's going to be worth more. I mean, sometimes management will make a bad decision and blow that money up, but most of the time they won't, right? So a company that you're investing in, which is what you're doing when you buy shares, they're always reinvesting and compounding your investment. But a property's not doing that. The only thing that's happening there is the actual land that it sits on. They're not building any more land, right? So there's a scarcity element there. But the physical building that sits on that land is actually deteriorating over time. It's the exact opposite of a company. So, as an investment proposition, a company makes a lot more sense. Shares make a lot more sense than a property. Um, and sometimes it's hard, I find, in the Australian context, to get people to appreciate that. And so a little bit of softening in the property market might just maybe reset, at least for the next generation. Hey, you know what? Maybe property's not the only game in town. Yes, I want a home. I want a roof over my head. I want that security. But beyond that, when it comes to building wealth, giving myself choices in the future, is an investment property actually what I want to do? Maybe there's a bit more of a rational number crunching done on that. And if the prices come off a bit, who knows? Maybe the numbers will start to stack up, but they haven't of the past decade or more.
Mm.
Yeah.
And it'll be an interesting, again, next 6 to 12 months.
I think even longer, right? It's going to
Yeah.
take 2 or 3 years because it is interesting the policy around new builds. You can still do negative gearing.
That is quite interesting. If you're gonna, yeah, and that's quite interesting. And also, if you buy an existing property down the road in Essendon and knock it down and chuck another two on it, you're extending. It's a new build because you're
You're increasing the
increasing the
supply,
vacancy and increasing the supply. So that would also allow for negative gearing on
which
the current.
I think that's a good thing, right?
Mm,
Because particularly, the inner suburbs, yeah, as you mentioned, Essendon, where our office is, there are big blocks, and these old suburbs really good for public transport, really good for facilities. So if you can knock down one big house and put two or three on it, I think that's good for the community, right? It's better use of infrastructure. You get a lot of people who want to downsize. They've raised their children, but they want to stay in the suburb because that's where their friends are. So,
mm.
that sort of stuff. Yeah, I think that's pointing the market in the right direction, and it is increasing supply.
Yep, but then on housing and, you know, if the older rundown house is the cheaper one, supposedly the more affordable one that those first home owners are trying to buy or trying to get into, and then the big developer comes in and sweeps it up because there's the opportunity to knock it and negative gear it, and that's what's it's that rules there. It's a bit counterintuitive into what they're
Yeah,
trying to
fair.
do.
But I mean, if they build, two or three on it,
Mm,
then the value per home is got to be less because now you're, in terms of land value, right? You're only paying for, let's say, if you could build three on it, you're only paying for a third of the land, right? So you would think the price point is less, but of course you've got a smaller home. I mean, there's no
mm.
no free lunch here, smaller backyard, and those kind of considerations, I guess, for children. To the extent that children play in the backyard, I mean, I think that's a bit of a myth at these days. Anyway, do your kids go in the backyard much?
Yeah, you got to chuck them outside, get them on, yeah, get
Just
them
kick them
kicking
out?
the footy and there, yeah. Two boys, lots of energy. They need to run around a lot.
Yeah, okay. Yeah, yeah. I mean, we had a park reasonably close. So to me, the backyard was more just somewhere for the dog to shit, right?
Mm,
The kids never really went out that much, but maybe it's because that was where the dog, did a shit. But anyway, yeah, I don't know that, the days of enormous backyards,
yeah,
I don't know how essential that is for most people these days anyhow, right? So, um,
100%.
yeah, yeah, yeah. But
Um,
still, yeah, property, the move in property markets, yeah, really interested to see how that plays out.
100%.
But my sense at the minute is if it continues at this kind of gradual just deflation, I think that kind of works, right? I mean, there'll be a
Mhm.
proportion of the population for whom it doesn't work for, but I would have thought for most, it's kind of accomplishing what everyone has said they've wanted for a long time, which is to improve housing affordability.
Yep.
I mean, obviously we're different generations, right? So amongst your friends who have probably newer homeowners and still got a lot of mortgage to pay off, I guess you would feel it more acutely, right? So what are you hearing, just when you catch up with your friends on the weekend?
A few of my friends are starting families and trying to upgrade home and whatnot potentially, but housing affordability, they're weighing up having kids and the expenses that that brings in life with, one day they need to buy a pram and send them to child care and determine public, private, Catholic school and all that.
Mm,
So there's other expenses and other factors that play into their mind that builds on top of, upgrading the home or buying their next home. Um, so there isn't, I did have a friend that was looking around in the market before all of these changes came in, and things were a bit too expensive for him, for the areas that he wanted to go. So it was in no financial advisor sense was I chatting to him, but we were just chatting about what compromise you have to make if it's not getting the car garage that he wanted, or if it's moving the next suburb out or the suburb after that suburb. Um, so if prices do come back, maybe he gets to move only one suburb or away rather than two suburbs, and there might be a fewer um, compromises that he has
mm,
to make on his ideal property that he's building in his head. But
mm.
it's just again a wait and see what occurs over the next for him the next 6 months, for everyone else the next 12 months, 2 years, 3 years, and see where we're at.
It's interesting if you cascade that thought through, that would suggest that ultimately the weakest is going to be the furthest out new housing estate type stuff. If it's the case that generally people want to be closer to the centre.
Hmm.
Uh, so yeah, someone who was previously going to be 7 kilometres out from the city, and okay, prices have dropped. Now I can afford to be 6 kilometres out from the city. So that the closer you are in, there's that. Yeah, there's always going to be that demand, but presumably the demand weakens further out. Yeah, it'll be interesting to see if that's the way it plays out, won't it?
But does it weaker further out? Because again, new builds, negative gearing,
Yeah, well, yeah, I guess, but you still need, well, you need
you
buyers, I
still need,
guess,
yeah, and tenants,
and you need,
and
and you
if you're
need,
doing that.
yeah, yeah, yeah. Oh
Anyway,
well, we'll find out in the years ahead.
that's it.
Good
That's it.
stuff.
Thanks
Anything
for
else we want to cover off this week, Nick? Have you
no,
got anything else on the agenda?
that's all for the agenda. Thanks for joining me today, Paul, and chatting through international markets and the changes coming up in those exchanges and housing and the interesting issues that raises. Thanks everyone for listening along as well. Feel free to drop us a message or share this episode with someone who you know who might find it interesting. You can also find us on the Guidance Financial website if you did want to have a conversation about your situation specifically. Otherwise, we'll catch you in a fortnight's time. Have a good day.